Now, you deal with mortgages every day in there. That's what you specialize in for investors. Are there any just overall mortgage industry trends that really specifically impact real estate investors that have occurred or are imminent?
Well, the rates. Everything is going to come back to the rates. As much as I impress upon people, it really shouldn't be about the rate. And I understand the psychology. Listen, but if they're not doing the math, they're really doing themselves and their future investment a disservice. The shelf life, you guys, of an investment property mortgage is 5 years. Okay. Whatever the rates are today, you're not going to have that interest rate almost certainly in 5 to 7 years. So, kind of looking down the forecast of where rates we think they're going to go, the appreciation of the property, harvesting equity, pulling cash out. Keep those things in mind when you fixate on the interest rates. I would say that that's usually what is top of people's minds. If you're watching this at all, you know that the most recent inflationary data came out. It was hotter than we expected. However, shortly thereafter, if you're watching closely, the unemployment rate and the jobs report, I think it offered 175,000 new jobs
Yes.
and the projection was two something. So that's good news. And listen, you guys, you can't have it both ways. We're in a hot economy. Okay, I guess it depends on who you're talking to and who you're asking. I understand, but for all intents and purposes, we've got inflation is down. It's not down where the Feds wanted that 2%. The unemployment rate is very, very low. So in that regard, we're doing very well. So interest rates are going to be higher. Unfortunately, it balances this way. The worse the economy does, the better the interest rates do. Finding that equal balance, I think, is the key. And don't ask me. I'm not going to try and predict how to do that. But do your math. Be prepared for refinancing when it comes. Sitting on the fence is usually not going to be to your advantage. If you're waiting for interest rates to come down, and that coupled with house values come down a little bit too, then you may have played yourself out of the refinance anyway for the purposes that you wanted to pull cash out. So just be educated. Call us. We can kind of walk you through some of that stuff. Interest rates, I think, are going to be higher for longer unless we see some real significant data trends, because there's a lag in what we get from the Feds, right? And I think they try to put that in there, but who knows what's going to happen? When are they going to see us again? June, July? We'll see what happens. If jobs reports keep being light, then maybe we start to see a little bit more reprieve in the interest rates. But we're what, 7.25, 7.5 for investment property, I think, in most cases. So if that's too high to cash flow, find a short-term rental, find a midterm rental. There's other ways in which to accomplish your variety of variables, even in a 7 to 7.5% interest rate environment.
Well, there's so much I could say about the Fed in the direction of interest rates, but I think you said something very important earlier, that the average shelf life of a mortgage loan product is about 5 years. It's exceedingly few people, well less than 1%, that are making their 360th monthly payment ever on a 30-year fixed rate loan.
Correct.
Well, Caeli, I want to ask you what maybe is becoming sort of known as the Caeli Ridge question. I like to ask you this almost every time that you're on the show because it gives us a temperature of the market. Because you see so many loans and so many appraisals come in there, what percent of appraisals are coming in above value? What percent are coming in on value? And what percent of appraisals are coming in below value?
We don't see as many low values. I think that there was a period of time where that was rampant. It was really frustrating for a lot of people, especially on the non-owner occupied side. I would say that the vast majority are coming in on point. And I think a lot of that has to do with 0809 regulation. Appraisers are kind of scared of their own shadow and overvaluating properties. So I think that they do everything they can to hit the mark. And I don't see too much over. On occasion, we'll see a little bit over. It's more likely to see it over than under these days. But I would say, okay, percentages under 10%, on the mark 75, and then over, we'll give it 15.
15. Okay, a few more over than under, but pretty close to right on value there. I know that the DTI, one exceeding their debt to income ratio threshold when they try to qualify, is sometimes a problem. So can you talk to us about some strategies with that? For example, sometimes a person might have a $500 a month car payment, but they only have four more payments to make for their $2,000 principal balance, and it just makes more sense to pay that off, and then that drops off the DTI calculation. Are there any other thoughts you have with regard to that?
There's so many, and this, I mean, we probably have our own episode for
Yeah.
all the different ways on debt to income ratio and to move that needle. Just to go back to your example, just FYI, if the car loan is financed, not leased, and there are 10 months or left reporting on the credit report, automatically per guideline, we can exclude that.
Ah,
If it was a leased with 10 months or less, we have to keep it in the ratio. But if it's a financed car, 10 months or left are showing on the report, it's automatically reducted or reduced from the liability section of DTI. The other things that we're going to look at, just obvious things, can we gross up any kind of income, right? Are there bonuses or commissions or Social Security or veterans benefits or whatever that allow us to gross those up? Making sure that we've got all of the applicable income that they gather. Sometimes people will forget to say, oh, well, I get this child support or alimony or whatever it may be that I didn't think to disclose. We want to make sure that we have that in there. And then when we talk about liabilities, here's kind of a good one. Student loans. Let's say that either co-signed or you have your own student loans. Fannie and Freddie have different, and maybe they're in deferment. Okay, so when we pull the credit, it shows 0 as the monthly payment. Well, Fannie and Freddie have different rules about what we have to hit them for. And I could be getting these backwards, but I think that Fannie is 1% of the outstanding balance, whereas Freddie is 0.5%. So depending on some other variables, we may elect to say, okay, DTI is really tight. We're going to take this and make this one a Freddie, assuming that they fit all the other boxes, so that we're only having to hit them for that 0.5%. Otherwise, we look at maybe paying off revolving debt, get those payments down. If they're small enough, maybe there's a $3,000 balance that has a $300 payment that's really screwing things up and they can afford to pay that off. So certainly we can look at those kinds of things, adding in a co-borrower, putting more money down, buying the interest rate down, maybe finding slightly cheaper insurance, right? At least for the purpose of the loan. And then if you wanted to get higher insurance or lower deductibles later or higher deductibles later, you could certainly do that. But so there's so many different variables that we can look at to really, it's not a one size fits all, and DTI is kind of a slippery slope, and there's lots of different ways in which we can get that down into check. And if it doesn't happen today, we can help them plant the seeds for what to do tomorrow and making sure that we get them there.
Wow, that was fantastic. I hope you, the listener, are listening closely because Caeli just gave so much packed, nutrient dense information about what you can do with your DTI. And for starters, I think a lot of people think about reducing their debt to improve their DTI, but is all your income being credited as well? Hopefully you caught that part when Caeli said that. But when it does come to reducing the debt portion, of course, student loans have very much been in the news with all these plans for forgiveness. Is that impacting DTI substantially?
If they have the right documentation, sure. Yeah, if they're on there and we have the right documentation that shows that they are forgiven, but they just haven't caught up with the system, then absolutely. Otherwise, if they don't have the supporting doc, the letter that says, and it's on the credit report, we're going to have to hit them for it, whether there's a payment there or a 0 deferred, and then we have to figure out the 0.5 or the 1%. It'll have to be in there. It just depends on what they can deliver in terms of that forgiveness in paper trail.
You do loans in almost all 50 states, and these are the states where the property is located, not where the borrower lives, right? So it's every
Correct.
state except a few.
Right. We're not in North Dakota, and we are not in New York. Otherwise, we are lending in all 48 states where the property is. That is correct.
And you specialize in loans for investors. Like I said earlier, what other loan types do you offer investors and others in there? Because you do a few primary residence loans too.
We do lots of primary. I would say, it's 70-30 probably. But we're very capable, full service direct lender. What that means is we fund on our warehouse line, we underwrite in house, but we don't service these loans. So we bundle them up in mortgage-backed securities and we resell them on the secondary market to aggregators. You guys will know this as servicers. PennyMac, Wells Fargo, whoever is going to be the end servicer of the loan. And I've worked really, really hard to create an environment specifically for investors, not exclusively, but largely, so that we're not a one size fits all. So I really appreciate the question and being able to articulate to your listeners, we really do everything. It's very uncommon that we don't have a loan product to feed the actual need. The one thing that I would say we don't have or don't offer is going to be bare lot loans. We don't fund on just bare land, but we can do the Fannie Freddies, bridge loans. So for the fix and flip or fix and hold, the BRRRR, we do non-QM. This is just non-QM is kind of everything outside the Fannie Freddie box. If you can't quite fit into the rigors of Fannie Freddie, you're going to be a non-QM, probably where debt service coverage ratio lives, bank statement loans live, asset depletion loans live. We have commercial loan products for commercial properties, for residential properties. We have ground up construction, first lien HELOCs. For relationship clients, we have second lien HELOCs. We had second lien for everybody, but we pulled back just for relationship clients for reasons that we'll discuss on one-on-one if anybody's interested in that. You get the point. There's a lot. If you think that you're trying to get financing for residential or commercial properties, please email us and we'll take some information and let you know what we can do.
Well, yeah, to my point, you provide such a great service and a wide palette of options. It's somewhat easier to describe what you don't do.
Yeah.
Than what you do offer to people. And of course, I've done my own loans in there at Ridge and my own refinancings in there at Ridge. And yes, I usually end up getting a servicer that's one of the big banks that you've always heard of over the long term that I make payments to. Well, where does one get started to get things rolling with Ridge or just to ask some questions?
Yeah, so call us, 855-747-4343, 855-74-RIDGE. You'll get to someone immediately. We don't have any call trees. You'll speak to me if I'm available at the time. Our website's got a lot of great information, ridgelendinggroup.com, email info@ridgelendinggroup.com. All of those ways will get you on the books with me if that's what you'd like, or assign you to a loan officer in the company. And we look forward to serving you.
You have given our longtime listeners more good, timely mortgage information than anyone in the history of the show here, and we're all better for it. Caeli Ridge, thanks so much for coming back onto the show.
Thank you, Keith.
You can watch this one next.